Welcome to The Explainer. Today, we're digging into the latest earnings report from United Health Group, America's biggest health insurer. And folks, this one is a real head-scratcher. So here's the big headline, and it's a bit of a paradox. The company brought in a ton more money, but somehow they made a lot less profit. Right? How does that even happen? How can you make more money but end up with less? Well, let's dive into the numbers and figure out what's really going on here. Okay, so first things first, let's look at the scorecard. We're going to put the third quarter of 2025 right up against the same period from last year. And wow, you can see the split right away. On the one hand, revenues, they just soared. We're talking over $12 billion more, a really healthy 12% jump. But then you look at the bottom line, and net earnings just fell off a cliff, a massive 61% drop. That is a huge swing. So the big question is why? To get to the bottom of this, to understand why profits took such a nosedive, we've got to look at one single crucial metric. It's the number that health insurers pretty much live and die by. And that metric is called the medical care ratio, or MCR for short. Now, the easiest way to wrap your head around this is to think of it like this. For every single dollar United Health brings in from premiums, the MCR is how many cents of that dollar they have to spend on actual health care. You know, doctor's visits, hospital bills, prescriptions, the whole shebang. So the higher the MCR, the lower the profit. Simple as that. And this chart, this right here, is the smoking gun. You see, last year, about 85 cents of every dollar went to pay for medical costs. This year, it jumped to almost 90 cents. Now, a 4.7 percentage point jump might not sound like a world ender, but when you're dealing with billions and billions of dollars, that's a tidal wave of cash flowing out the door. It is without a doubt the number one reason for that profit collapse. Okay, so what was behind this spike? Well, it wasn't just one single thing. It was more like a perfect storm. You had patients just using more healthcare services than anyone expected. At the same time, government funding for some big plans got reduced. Then, new rules like the Inflation Reduction Act shifted more drug costs onto the insurers. And, to top it all off, the new folks they signed up ended up needing more medical care than they planned for. It was just one hit after another. Now, to really get the whole picture here, you need to know something important about United Health. It's not just one giant insurance company. It's really two massive, very different businesses under one corporate umbrella. And believe me, they did not feel this pain equally. So you've got United Healthcare. That's the part you probably think of, the traditional health insurance side that covers about 50 million people. But then there's Optum. And Optum is this fast-growing health services beast. They do it all: technology, data analytics, they manage pharmacy benefits, they even own their own clinics and doctors' offices. And their stories this quarter were very, very different. And here's the proof. Yeah, both divisions saw their earnings go down, but look at the difference. The insurance side, United Healthcare, got hammered. Its earnings were down a staggering 57%. That tells you everything you need to know. Those higher medical costs we've been talking about, they landed like a haymaker right on the insurance side of the business. What's really interesting is that in their report, the company they were surprisingly honest about all this. They didn't try to sugarcoat it. They actually admitted where they messed up their own forecasts. And check this out. This quote is straight from their management discussion. I mean, they're basically saying, oops, our predictions about costs and how healthy our members would be, they were way off. For a company this big to just come out and say we got it wrong, that's a pretty big deal. It's incredibly frank. But, and this is a big but, it wasn't all doom and gloom, not by a long shot. Let's talk about the bright spots. First, the company's still growing. They added almost 800,000 more people. That's huge. The pharmacy part of Optum, OptumRx, had a great quarter, growing revenues by 16%. And maybe the most important thing, this company is still a cash-generating machine. We're talking $5.9 billion in cash from operations in just one quarter. Okay, so after a quarter like that, with profits falling through the floor, you'd expect them to be pretty nervous about the future, right? You'd think they'd issue a really cautious forecast. But that is not what happened. In a twist that honestly surprised a lot of people, United Health Group actually raised its earnings outlook for the whole year. Yep, you heard that right. Even after this really rough quarter, they're basically telling investors, don't worry, we've got this. We can manage these higher costs and get things back on track. And that really leaves us with the big multi-billion-dollar question, not just for United Health, but for the entire industry. As healthcare costs just keep climbing for all of us, can a company this massive, can it really find a way to balance what its shareholders demand with what its patients actually need? That's the tightrope they have to walk, and this quarter's results really bring that challenge into sharp, sharp focus.